Welcome to this week's version of Nickels and Dimes, our weekly video series. Well, the market is pulled back. We have a little correction going on right now, which frankly, historically speaking, in February is normal. It's one of the weaker months of the market historically. But how are investors feeling? I know by and large, many investors are concerned. There's concerns about tariffs. There's obviously concerns about a potentially slowing economy and various concerns. There's always going to be concerns in the economic environment. But how are investors currently feeling? And I'd like to share this with you today because it might provide some insight on where the market is headed. If we look at history as any guide, how do investors feel about stocks? And one way to find out is to tap into what's called investor sentiment, which is also known as market sentiment, which is the general attitude of investors towards the market or a particular security. And it acts as a contrarian indicator. When the masses believe one thing is going to happen, the opposite generally does. So doing the opposite, where you intentionally go against the prevailing market sentiment, where, for example, you would buy when most investors are selling or fearful, or sell when most investors are buying or greedy, because the belief is that the market can overreact and create undervalued opportunities. Now, you might recall back in 2021, when the markets actually peaked, because you might recall the equity markets were down in 2022, and of course we've had a recovery since, but there was so much over-the-top bullishness in 2021, when, for example, you think, when you see a headline like, stocks for the next decade, or these must be the 10 stocks you have to own in the growth stock space. Or you might recall in 2021, the meme coins like Dogecoin, the price was going through the roof. When you have this irrational exuberance where the average investor thinks when they invest in something speculative, might think they're going to make money forever and get rich quick, that is an indication that there's a lot of greed in the marketplace, and you might want to start actually selling to take risk off the table if you see these types of indicators. And particularly, it's an indicator that you might not want to put money to work, because again, the masses are generally wrong by and large. So how do investors feel about the current equity market environment? And here's an indicator by a very large media publication. They call this the Fear and Greed Index. Most recently, particularly when it comes to the equity markets as measured by the S&P 500, folks are in the extremely fearful category. I mentioned earlier, because of tariffs, there's concerns about a slowing economy. This is one financial publication. The masses are currently very fearful of the equity markets. That's one media outlet's resource. Another one is from the American Association of Individual Investors. This is a survey they've done weekly since 1987, and they ask one simple question. And the question to members is, what direction do members feel the stock market will be headed in the next 6 months? So it's going to be up, neutral, or down. And here is the most recent indicator, which is astounding. The direction that most members feel the market will be in the next 6 months is bearish or down. That is indicative of how the current market environment is and some of the concerns folks have, particularly how investors feel about the current stock market environment. Now, how does this compare to the averages? On average, investors are around a third. So a third bullish, that is indicated by the green here. The neutral is around 31%, this gray area. Bearish is around 31% as well. On average, you get, when you ask this question by AAII, a third of the folks think things are going to be rosy in the next 6 months. A third of the folks thinks that things are going to be neutral. And again, the balance feel like, on average, things are going to be negative. Now, what happens historically, at least since the 1980s, when we have a spike, if you will, which is what we've seen in this survey? And you can see here by looking at the vertical lines going back to the late 80s to the early 90s, when we have an increase in bearish sentiment, meaning overly negative belief about the stock market over the next 6 months. Look at these lines in the late 80s and early 90s. And around 2010, you could see we had a few of these vertical lines where investor sentiment was quite bearish. Early 2000s, and even most recently in 2025. This, in fact, was the 7th highest spike in bearish sentiment since this survey started back in 1987. This is absolutely astounding. And now I will remind you, the equity markets, particularly the S&P and NASDAQ, have corrected around 5 to 10%. And again, in short order, it has some people concerned, but folks are getting absolutely concerned about the equity markets falling apart. And this is a very big indication of, again, how folks are feeling. Let's look at this historically. This typically, meaning when investors are this bearish or this negative, this typically indicates, at least short term, that the bottom is near. Because I want to make the point, when the masses believe one thing or another, so if they think, for example, if I showed this indication of this AAII survey, if folks were overly bullish, in other words, if they thought the equity markets were going to be higher over the next 6 months and the ratio was 50, 60, or 70%, that to me is an indication that folks are being way too greedy, way too optimistic, and that's very likely an indication we need to start selling or raising cash or maybe taking some chips off the table. And of course, we wouldn't be putting cash to work in the equity markets, right? But all that to say is you still must have, in our opinion, very specific 3 things here. Number 1, clarity on your goals. Make sure you understand what your goals are. Number 2 on this list is have a plan. Once you get clarity on your goals, have a plan, a written plan to help you accomplish your goals. And number 3 here, develop an investment strategy that's based on 3 things. Understanding what your risk tolerance is, have a growth and protection strategy, and absolutely understand what your family index number, that is, what is the rate of return that you need to earn now and in the future to live your ideal retirement life. Yeah, I got a number of emails a few weeks ago because folks were concerned about the markets because some of the tariff concerns. It's absolutely understandable. But if you have a plan, a strategy in place, you will likely not make irrational, emotional decisions, because sometimes people do that, of course, when they read a bad headline. If you have a plan in place, you'll likely stick with your plan. Again, make adjustments in time because your plan is, again, based on your goals and these factors like risk tolerance, an investment strategy, and your family index number. So hopefully you found value in this video. To that end, if you did find value in this video, if you're getting it on social media like Facebook, LinkedIn, or YouTube, go ahead and share it. And if you get it in an email, go ahead and forward it to a friend. All that to say is if you would like a second opinion on your portfolio or financial situation, this is our website at nicholswealth.com. Click on our website here, this requested appointment time. You could fill out the information and one of our advisors will reach out to you, answer your questions, and give you some clarity in today's challenging, volatile, and potentially rewarding financial and economic environment. Thanks again for watching. Bye-bye.